Economic growth fell sharply to 5.4% for the quarter ended September this year. What does this mean for India? Are we looking at a prolonged economic slowdown? And as importantly, what will the RBI do? Will it cut benchmark interest rates, as many observers have been expecting it to do for some time, so that lower interest rates may spur economic growth? Or will the latest print of consumer inflation at a high of 6.2% force the RBI to maintain status quo? Hello and welcome back to Business Matters at the Hindu with me, K. Bharat Kumar. Before we go to the topic of the day, here are 3 things you must know. US President-elect Donald Trump has threatened 100% tariffs on countries, including India, if the BRICS nations came up with their own currency to move away from the US dollar. Indian Foreign Minister Mr. S. Jaishankar has clarified that there was no plan for BRICS nations to come up with a common currency. Following Trump's threat, the Indian rupee got jittery and hit a record low against the dollar on Monday. Domestic passenger vehicle sales dipped in November, and retail sales are likely to touch 3.3 lakh units versus the 3.8 lakh seen in the same month last year. Cyclone Fenjal has caused devastation in specific regions in southern India, as in the case of Kadalur and Krishnagiri districts in Tamil Nadu, and is now approaching the western coasts. Estimates by agencies have placed the total economic loss at Rs 150 crore. Back to the topic of the day, GDP growth. The uninitiated could argue that 5.4% economic growth is growth nevertheless, so why make a fuss is a common question that abounds. But this 5.4% for the quarter ended September compares with a higher 6.7% growth seen in April-June of this year and a much healthier 8.1% seen in the same quarter last year. In the July to September quarter this year, manufacturing at 2.2% and mining and quarrying, which contracted 0.1%, were the most sluggish. By contrast, agriculture expanded 3.5%, higher than any increase reported for the sector in the previous 4 quarters. Now, what does the government make of these figures? Chief Economic Advisor V. Anantha Nageshwaran said that though these figures were disappointing, they were not yet alarming. Kotak Mahindra Bank Chief Economist Upasana Bharadwaj said the lower GDP figures reflected the disappointing corporate earnings data that have come out so far. Gross fixed capital formation, a measure of investments by both the government and the private sector, grew at an anemic 5.4% for the quarter ended September. The government likely cut back on spending, and the central government was the one that had been nudging growth via public capital expenditure over the past several quarters. The slowdown in public spending or the government spending in the latest quarter has been attributed by observers to factors such as inclement weather, a delayed budget, and if you look at the first half as a whole, then the general elections in May. The monthly Purchasing Managers Index, or the PMI for manufacturing put out by S&P based on monthly surveys, showed that economic activity had expanded in November, no doubt, but expanded at a slower pace than in the previous month. Government data released on the Index of Industrial Production showed that industrial output had increased 5.4% for September, but this was after contracting 0.1% in August. So you see that these macro indicators are not consistently giving out good news. It's been a bumpy ride. Next, let's look at credit growth. Credit growth is the increase in the quantum of lending by banks, and this is a good lead indicator for economic activity and growth prospects. A Macquarie analysis showed that credit growth, which was recorded at 16% year-on-year for the month of March, had fallen to 11.5% year-on-year again for October. So much for the latest quarter and the first half of this year. How do things look for India in the upcoming second half? Chief Economic Advisor Anantha Nageshwaran said it was too soon to say that a lower range of growth estimates, that is 6.5 to 7%, is in danger. He said, we will go back and take stock of the full year number. He also said estimates of record production for the Kharif crop signal healthy farm income and rural demand. Brokerage Jefferies has estimated that government capital expenditure would grow 25% in the second half of this year compared to the same time last year, and that, many hope, would pave the way for a return to higher economic growth. However, some economic observers seem wary about future growth. Barclays, for instance, has lowered its estimate for economic growth from 6.8% to 6.5% for India. While lower economic growth is not great news in itself, it now places the central bank, the Reserve Bank of India, in a dilemma. The RBI is mandated to target 4% consumer inflation, allowing for 2% movement on either side. Retail inflation zoomed to 6.2% in October this year, breaching the central bank's tolerable range of 2 to 6% for the first time in 13 months. If retail inflation is high, the RBI generally tends to keep benchmark interest rates high because it wants to temper demand by keeping the cost of borrowing high. There are too many highs in the sentence, but that's the nature of the beast. But if economic growth falters, the Reserve Bank and the central government generally tend to work together. The government increases capital spending while the RBI lowers interest rates with a view to increase consumer spending and spur economic growth. Now, the RBI is faced with a double whammy, lower than expected growth and a higher than tolerable inflation. Consensus among observers is the RBI will not cut rates in the Monetary Policy Committee meeting that is slated for this week, and an announcement on which is expected to be made by RBI Governor Shaktikanta Das on Friday, December 6th. So the consensus is that the committee will not cut rates, it will wait and watch. HDFC Bank in a note said that it expects the MPC of the RBI to cut rates only in the February 2025 meeting. An editorial in Business Line says that the government can indeed raise capital spending without fears of stoking inflation. It argues that in a demand-deficient economy such as India's, inflation is ruled more by fluctuating food prices, a weak rupee, and high commodity prices. And with those in the government favoring a low interest rate regime, they point out that recent inflation numbers were driven by food supply issues over which the RBI had no control, and that using the interest rate lever would have little effect on the cost of food. Some analysts are hoping that the RBI in its Monetary Policy Committee meeting this week, even if it wants to keep the benchmark interest rates the same, wants to wait and watch, does not want to cut those rates, they're hoping that it would indeed tweak the CRR lower, or the cash reserve ratio lower. What is the CRR? Assume that I'm a bank and I have 100 rupees to lend to whoever wants to borrow. The RBI mandates that I have to keep aside this 100 rupees, possibly obtained from customer deposits. Keep aside 4.5%. At the current rate, it's 4.5%. So for every 100 rupees that I get as customer deposits that I could use to lend, I must keep aside 4.5% or 4 rupees 50 paise. I cannot lend that out. The CRR is a tool that the RBI uses, and it helps it calibrate liquidity in the economy, helps the RBI fight inflation and so on. So for every 100 rupees that I as a bank have as customer deposits, earlier if I had to keep aside 4.5 rupees aside as part of the CRR, I cannot use that to lend and make money for myself. If the RBI tweaks its rate lower, the CRR rate lower, say maybe if it says 4%, then I need to keep aside only 4%. So I have that much more money to be able to lend, make profits for myself, but also help spur economic growth. As the rest of the fiscal year unfolds, let's see how India's economic growth and inflation pan out. And that brings us to the section where we give you nuggets of information as usual weekly. Here it goes. Did you know that the first recorded attempt at comparing prices was by William Fleetwood, the Bishop of Ely, who in 1707 wrote an account of his efforts to explore the course of prices over a period of 600 years? That brings us to the quiz question of this week. What is the worst recorded rate of inflation ever seen around the world? And here's the answer to last week's question. When was the first recorded incident of bribery in history? The answer is the first dynasty of ancient Egypt in the time period 3100 BC to 2700 BC. This first dynasty of ancient Egypt noted corruption in its judiciary. That's all we have for you in this episode. If you liked what you saw, do not forget to press the like button, share and subscribe. Till we meet again next week, have a good time ahead.